Hi everyone. So this semester I worked on a trading bot that uses soft tactic Critic. Buying low and selling high is very important to making profit from the stock market. And a trading bot that can learn how to take advantage of these price fluctuations by knowing when a stock price would rise or when it would fall could be a very important asset to hedge funds as well as retail investors like myself. There's been a bunch of previous work in this field. So usually technical and fundamental analysis is used by most traders, hedge funds and trading firms. And there's also been some research in machine learning and deep RL techniques to this problem, specifically DDPG, deep Q learning, or PPO. So this is how my trading environment is set up. The observation space consists of the current balance available to the trading bot, as well as the RSI, MACD, CCI, and ADX of the 30 Dow Jones stocks. These are basically technical indicators using which the bot has knowledge of the price fluctuations of all the 30 stocks. And I also included the current closing price of each stock and the quantity held of each stock. Um, the action space consists of 30 dimensions. There's one for each stock, and each action ranges from +1, which is buying the maximum amount possible, to -1, which is selling the maximum amount possible. And the reward in this environment would simply be the increase in the net worth from the previous step. Here are some of the tricks that I used and some insights that I gained. So I scale the rewards down by 10 raised to -3, and I also use a smaller replay size of 40,000. I found that soft tactic Critic was really good with this environment because it tries to maximize the entropy along with the reward, and that's very important for exploration in our environment which has a very large action space. I also use prioritized replay and tuning of the entropy parameter during training. Another thing that I found was that technical indicators are very important to the state space, and without these technical indicators, the agent wasn't really able to learn much from just the current closing prices of all the stocks. Here's how my experiments are set up. So I train on data from 2009 to 2017, and I validate and tune my hyperparameters on data from 2017 to 2018. And I would finally only be testing once, and that's from 2018 to August 2020. And to make some sense of my results, I would be comparing with the baseline strategy of buying and holding all 30 stocks, which is the same as buying and holding the Dow Jones index. And that's probably how much an average investor could make out of the stock market during this testing period. My training curve looks like this. So the agent pretty much fits the training data pretty well, and it even tends to overfit the data slightly. On the validation set, the agent can get a profit that's much higher than the baseline pretty consistently throughout training. Finally, here are my test results. So on the x-axis is the date, which ranges from 2018 to August 2020, and on the y-axis are the cumulative returns for both the baseline strategy as well as the trained agent. Both start off from 0, and the baseline strategy is in orange, and by the end of the test period, this buy and hold baseline strategy can only get you a return of around 8%, whereas the trained agent gets 43% return by the end of the test period, which is quite a bit higher than what the baseline strategy could get.